how do you get into the India investing game, or how do you get a slice of the growth in India? One of the ways I was thinking is, how about if you look into the banks in India? Because one of the things I see with India is it has a really positive demographics, and that's going to stay for the next 30 years.
Great seeing you. So, Hari, you asked here before we hit record whether or not we could talk about the economy in general. And I made the disclaimer, I don't know about anything that's going on. We are supposed to be micro investors, not macro investors. And because of that, perhaps we should, I don't know if you have a question you want to ask Toby about macro then.
My question essentially was that some of the stuff that what Milton Friedman or any of the textbooks would have suggested is not happening. For example, interest rates was raised at the fastest rate in history, as they were saying, but inflation is kind of coming down, but not that much. We don't see a dent on the housing prices. In fact, that it's steadily raising. The stock market is also ripping. It's doing well. There is geopolitical tensions. There are wars going on, but nothing seems to be impacting the key indicators of wealth, which is stock prices or home prices in United States, at least. And I wanted to know what's going on. What are you guys thinking? Like, is it puzzling you, or is there an explanation? So Toby, Stig, I would like to know, what is your opinion?
I've got some observations. I don't know how much of this is causative or what's really going on. But the first thing I would say is, like you guys, I am not a macro investor. I largely ignore the macro, not because I don't think it's important, but because I don't think I can figure out what's happening. I've looked back through, you guys know I love a little bit of market history. If you look back over the last few hundred years, there have been wars and crashes and depressions, and none of them were predictable. Even in hindsight, they're not predictable. So the best setting is just to invest according to where you are in life. You have your exposure set and you plan for anything that could happen. You can have a bust, you could have a crack up boom, and you're just in a position where whichever one happens, you don't really care. I call it regret minimization. That's really my objective. Whatever happens, I just want to be the least upset. So if it goes up a lot, I'll be fine. If it goes down a lot, I'll be fine. I don't really care. So that's everybody should get to that point. So you don't have to be predicting what's going to happen to position yourself, because that's very hard. And the one time you get it wrong, you could blow yourself up. What I think has been happening though, the stock market inversion continues on. It's the 10-3 inversion, which is basically short dated interest rates, treasuries are high and longer dated interest rates are lower. And it's unusual because ordinarily when you're putting money out at risk, the longer you put it out, the more you get, because you've got to contend with inflation. There are risks that you won't get your money back. You don't have the use of your money. So for all of those reasons, they typically attract longer rates for the more time you got to put it out, and you get lower rates for shorter periods of time. That's not happening at the moment because the Fed has lifted up the front end rates. That's the 3-month. And they do that in an effort to slow the economy because it was too hot. We had inflation. The Fed has a dual mandate. It's full employment and stable prices. Employment's at all-time lows. Prices have been not stable because we've had a lot of inflation. So put up the interest rates to try and cool the economy. And the result will be some unemployment. And that's typically what has happened. And that manifests an inversion in the 10-3 yield. And so when that happens, after a period of time, it's unpredictable. There's usually a slowdown in the economy. When you have that, you typically have a stock market crash, real estate market crash. Everything gets set lower. And I think that's probably explicitly what Powell's been trying to do, get housing prices down, maybe stock market prices down. None of that has sort of happened yet. And it's the longest inversion we've ever had, or going back in the data, there may be longer inversions that aren't captured in the data. It was also the steepest or the deepest inversion at one point. There's no real correlation between any of those things and the resulting recession or depression or whatever follows, other than the fact that they tend to be for about the same length of time, because the lag is so long between raising rates and it actually impacting the economy. It's like 18 months or 2 years or longer. So Fed raises rates, waits, nothing happens. 18 months later, there's a stock market crash and they panic and they lower rates as rapidly as they possibly can. But it has no, you can see in all of these crashes, the Fed's lowering rates rapidly. And it has no impact because the lag is so great and they've sort of overplayed their hand a little bit. I don't know what's going to happen here, but I probably guess it's something similar to that. I think the reason that it hasn't happened yet, and the reason that stock market's at all-time highs, real estate market's flying along, unemployment remains low, we're running massive deficits on the fiscal side. So the federal government has these Inflation Reduction Act, which is actually doing the opposite of what it says. There's a lot of spending, and that spending goes out into the economy before the money is collected to pay for it in taxes because it's done on debt. It's done with debt. And Milton Friedman, it's funny that you raise his name. Milton Friedman used to say, the thing about inflation and spending is that it feels best at the start. It's like drinking. It's like alcoholism. You feel great while you're drinking and the hangover then follows after the fact. And so nobody thinks they're making a mistake while they're doing it. And the more you do it, the better it feels. And then you wake up the next morning and that's when you get the hangover. So I think probably that's where we are at the moment. It hasn't shown up yet because there's so much spending. Obviously, because we've got an election coming up, that's one of the levers that the incumbent administration can pull. They can spend a lot of money. That makes the economy look better than it otherwise is. And then you get the other side. I don't think it really matters. I'm not particularly political when it comes to the economy. I think whichever team comes in, they'll be both spending. So I don't really know. We're in a grand experiment. I don't think any of this has been tried before. We've got the brakes on and the accelerator on at the same time. So I'm interested to see which one person's got their foot on the accelerator, the other person's got their foot on the brake. No one's got their hands on the steering wheel. Should be fun.
Yeah, that was interesting, Toby. Thank you. And we are in for a fun ride, I guess, in the next couple of months.
It's like the Chinese curse. May you live in interesting times.
Yeah.
Yeah, I think you ask a great question, Hari, about the current conditions. I should probably also do my disclaimers and then do a long rant afterwards and then end by saying I don't really know. But I think I want to take one step back and then say that to Toby's point, when we talked about wars and everything else and the bigger macro events. And I remember whenever I started investing a long time ago and I had my rites of passage going through all Buffett's letters and whatnot. And he has this famous paragraph about, how well the Dow has been doing. And keep in mind, like we are talking about olden days now because we're talking about the Dow, when not like the S&P 500, like the modern people who talked about the S&P for 40 years now, but talking about the Dow. And he talks about how well it did in the 20th century. And then he lists all the problems we had in the 20th century and just the stock market marching on. And I think we can come up with a lot of reasons why, this time is bad. Time has always been bad. And so I think the way that I do this, and I don't do anything that's very sophisticated. I don't have a quant AI fancy algorithm or whatnot. I'm very much in stocks because I do believe in general that the economy is expanding and we all become more productive and so I don't think I bring anything new to the party on that, and I do think most people do themselves a disservice if they look too much at the macro and deem that now is not a good time to invest. And then at the same time, I also want to have a bit of insurance. Like I completely agree with Toby. Like whenever you look at the fiscal deficit and like there are some funky things out there. There's huge debasements and of currencies, and you're like, there are a lot of people out there who are going to tell you that they know what's going to happen. They're probably just smarter than me. I have no idea what's going to happen. I do see a lot of weakness. And so the way that I'm trying to hedge my bets by being long in the stock market and have always been long in the stock market is that I hold physical gold. And, that has looked like a foolish trade for a very long time. I don't remember the last time I pitched gold here in the Mastermind. It's probably like 3 or 4 years ago, something like that. And gold has just more or less done nothing. And then here recently, it's been on a tear, and I don't make any kind of naive assumptions that gold are going to perform the stock market or, we're going to go back to a gold standard or anything like that. That's not why I invest. Partly I do it because I get taxed way better, and my after-tax returns are what I'm optimizing for, not my pre-tax returns, but also because it is my insurance to perhaps the stock market doesn't keep on going up whenever you are rolling back over the past 20 years or whatnot. And so far, so good. So that is my boring answer to that question, Hari, and how I position myself.
No, they were both really helpful, actually. Thank you. And the key point both of you are making is regret minimization and position yourself that it's a kind of an all-weather portfolio so that you don't have to keep guessing what happens to the economy. And gold is a very interesting point you brought up, Stig. Because I remember Jim Grant saying he would like to have an investment that he kind of doesn't really agree. And if nothing is hurting in your portfolio, something is wrong. So in that sense, I think these are really good answers. And thank you.
What do you think about Silicon Valley from your perspective? Because that's been a big engine of growth for the US probably versus the rest of the world.
Yeah, I think as you might have seen in the most of the quarterly announcement, what I'm seeing, at least in many of the companies, is the focus has been moving from growth, just revenue growth or growth at all costs, to responsible growth. I'm seeing a lot of companies highlighting their margin growth more than their revenue growth. And in some cases, the revenue growth is slowing down too. But in some cases, even if the revenue growth is healthy, they are basically projecting their margin growth, which also reflects the sentiments the Wall Street is kind of, reflecting on them. And also it's also the life cycle. Many of the high-tech companies are in their 20s now. So, and they're kind of probably realizing that, okay, they're entering midlife. But what is interesting is, for a while, we haven't seen another Uber or another Google come out of Silicon Valley. That means what I'm saying is there have been many IPOs, but there haven't been companies of consequence for the last 10 years. There was, in the 2010s, there were like a bunch of companies like Facebook and others that went public, which became companies of consequence. But lately after that, at least there aren't companies that are that big of a consequence yet. Maybe OpenAI, but that's where I see that, things changing in the Valley in terms of focusing on margins. Acquisitions also have kind of dried up, even though we still see acquisitions here and there, but less acquisitive companies. So that's what I see in the Silicon Valley.
I should probably not take everyone else who was investing down with me on my low level when I say this, but I think, or at least I hear a lot of people talking about where there's so much disruption right now. And I've heard myself say that many times, like, disruption is like faster and faster, better and better. And like, it's so difficult in today's market. And then I read this book the other day. I want to say the name of the book was The New Goliath. And it's not a great book, I should say. So please don't go out and buy it. But like, it had the premise of we don't get disrupted that much. Most of us know the innovator's dilemma, right? And he said like that was around the time that disruption were peaking. And then the author makes the argument that because of big tech and mainly, and there are a few other reasons, but he zoomed in on big tech, to your point, Hari, and you don't really see a lot of disruption right now because they're so big and they have so much market power. And so I kind of felt that was an interesting take. Do you think he's right about that? It's just too difficult to compete with the big tech companies now? Or, I mean, not saying that we won't see any disruption. I just don't think that's how capitalism works. But are you seeing a downward trend in the Valley right now in terms of disruption?
Yeah, I think that's a very good point, Stig. In fact, Balaji Srinivasan, who is one of the VCs, he was former CTO of Coinbase, in an interview said like AI is a technology that makes centralized power more powerful. So whereas crypto or chain is a decentralized technology, so it makes the centralized power less powerful. So that's why the Chinese Communist Party would go after the crypto and the blockchain, but they would embrace AI because that makes them more powerful. Similarly, in the context of big tech, because of the resources involved, there is a horde now to get NVIDIA chips. And not everybody is getting it. It's either Amazon, Google, Microsoft, or Meta. So even OpenAI cannot afford it. That's why they partnered and kind of, went with Microsoft because they could use Azure. So it makes it harder and harder for small companies to come up. The only encouraging sign I see now is Llama, which is a open source LLM by Meta, and Meta completely backing it, and they have their own motives to open source it. But that might help smaller companies get a leg up, but still it is very hard. And that's, I think whatever that book is quoting might be actually true. In fact, Peter Thiel also says, and his tagline for his book or his fund also is, we were promised flying cars. All we got was 140 characters. So, and Peter Thiel's, for a long time, his gripe was that we aren't innovating fundamentally the way we did in the 1900s. We are just going after photo apps or social network apps and stuff like that and thinking it is innovation, but it is just application of a fundamental innovation, which was internet that was made. So I think in that sense, yes, innovation has definitely slowed down. And I think we are, especially in Silicon Valley and maybe in other places too, we equate digital innovation to innovation. But I think digital innovation is just an application on top of innovation. It's the fruits of the innovation that was internet. But what I think Elon Musk is doing with SpaceX or Tesla, those kind of companies are far and few.
So my pick for today, and I should probably preface this by saying that whenever I look at the stocks I pitched at the early Mastermind episodes, it was usually cigar butts. And optically, they were cheap. There was some hair on it. And then I got this horrible habit of pitching high quality stocks and with high multiples. And I kind of felt I wanted to mix it up and go back to the roots here. So I wanted to pitch a cheap stock with hair on it. And I think I was going through like my Rolodex of different picks. And I was like, I want to see if I can impress Toby and see if I can find a lower PE than Toby this time. I think we're neck to neck on this one here though. I just looked it up here before we started recording, but the stock I'm going to pitch today is Burberry. And the stock is trading on the London Stock Exchange under the ticker BRBY, and you can also find OTC in the States under the ticker BURBY. And full disclaimer, this is not a stock that I own. And there's a little hair on it. It's not too much hair on it. I'm not going to pitch like a 3 PE stock, unfortunately. It's trading around a 10 PE, which is quite unusual for a luxury stock. And I would also say that it's not a high quality stock. It's not going to compound for decades, even though it has shown decent growth. So we're not looking at a growing pie. I think the thesis I want to present for you today is, let's call it a discounted pie. And, a lot of value investors has said something like discounted pie over the years and found themselves with a value trap with something that looked cheap and then time just passed by and opportunity cost and they sort of like regretted that. So I'd be very curious to hear how much you're going to beat up this pick. But let's get into it. So for those of you who are not familiar with Burberry, so it's a company providing clothing, accessories for men and women. Perhaps it's best known for its iconic trench coat, but you can think about it as a fashion retailer. I do want to bring the argument that perhaps we're talking about luxury and not fashion later here in the discussion. But you can think shirts, pants, bags, shoes, and whatnot. It's a very opposite of AI, if I can be as liberal as that. So you can find Burberry in 225 stores worldwide. They also have 133 retail concessions and a small number of outlets. The biggest markets are Asia Pacific, then you have Europe and the Middle East, and then Americas. And I think it's important to say that whenever you're looking at Burberry, it's not a company that is growing its footprint right now. It's currently going through a refurbishment of stores worldwide. It's halfway through, and it expects to complete it by fiscal year 2026. The bigger stores, and after they've been refurbished, they're going to have a VIP shopping area, most prominently the flagship store on Bond Street in London. And so this is a brand from 1856, founded by Thomas Burberry. And it's built around the idea of modern British luxury. And a brand, of course, it means a lot of different things to a lot of different people. But I think that there is a consensus right now in the industry that the changing creative directors have created some confusion around the brand. And it's also trading near a 52-week low. And so the current chief creative officer, so not to be confused with the CEO, he started in 2022. His name is Daniel Lee. And then a new CEO came in, Jonathan Ackroyd, and he came from a position from Versace and also the sales from Michael Kors, whereas Daniel Lee, he came from a successful time at Bottega Veneta before then. And so as I'm going through this breakdown of Burberry, I just want to say I'm going to give you British pounds unless stated otherwise. So one of the traps of analyzing a stock is listening too much to what the management is saying. Because whenever you do that, all of a sudden the valuation starts to look very appealing. So let's see if we can discount for that. But right now they have around 3 billion in top line. And then if you go through the filings, they talk a lot about 4 billion in medium term, 5 billion in long term, of course, without defining whenever medium and long term is. But it is a stock that has shown decent growth in the past. So where's that top line growth is going to come from? Some of that is going to come from having these stores, like I mentioned before, refurbished. We've already seen, or investors, the company have seen, improvement of 15%-ish in sales per square meter in those stores that have gone through the process. Another thing I also want to add is, as a luxury brand, you also have decent pricing power. So some of the top line is also going to come from that, more than volume necessarily. It's one of those things where you don't want to focus too much on volume, because then you also end up diluting the brand. And so they have a stronger focus now with a new creative director of 50% should come from accessories, and that's currently at 37%. And so I think the sort of like to place Burberry on the map. It's very easy to compare them to high-end luxury brands like the MS of the world and then say, well, Burberry kind of sucks, and this is a terrible company. And you might also say, well, Burberry is not true luxury. Like it's not MS, it's not Chanel. Why would you invest in that company? And the first thing I would say is that, well, MS is trading at 50 times earnings. Burberry is trading at 10 times earnings. So that's probably the first thing I would say. But I would also just say that within the luxury category, you also have a lot of different tiers. And whenever you are looking to buy a $2,000, $3,000 Burberry bag, you're not looking at buying a Birkin bag that can be more than, that could be more $100,000 for a Birkin bag, even though they start at $12,000 now. Like, the customers are very different. And then you bring an argument, well, Burberry doesn't fully control their supply chain the same way as the high-end luxury producers. They're not all produced in high-income countries, and you'll be very much right about that. But the thing I would want to say to challenge whether Burberry is fashion or not, and I do think it's important to challenge, because as soon as you put them into a group of fashion, it also means that you have to look at the future discounts a little bit different. And so what do I mean by that? Well, Burberry was established in 1856, and 50% of the revenue comes from its core products. It doesn't come from the newest collection. In the world of abundance and AI, you want to look at which companies are anti-fragile. And I'm not saying that Burberry is anti-fragile, but it is a brand that's been there for more than 160 years, and it's not depending on whether or not the latest collection for the summer or whatnot is perceived cool or not. Like, the strategy is quite different for a company like Burberry. And it sort of like also takes me to the point of, and also keep in mind, of course, I'm providing the bull case here for Burberry. If I didn't spend all my time talking about why it's an inferior company to MS, for example, but instead said, hey guys, I found this company, it has stable 70% gross margins, stable 20% operating margins, decent growth, it's trading at 10 times earnings, it's been there for more than 150 years, you would probably be like, tell me about it. Like, that sounds promising. But let's talk about some of the bad stuff. So one of the things I really like about a company is if there's a high insider ownership, especially if management is in charge, and it couldn't be more the opposite whenever it comes to Burberry. So I do think that is a concern that I would have. Management own very little stock, and a significant part of the compensation is tied to how well the company is doing, which by definition can work against you as an investor, because they could have the wrong incentives. Let's say they would start issuing shares that you don't want to at the wrong valuation or whatnot. The management do have some ROIC, and there's a return on invested capital, which is sort of like counter to that. But if you look at how the compensation is structured, it doesn't carry the same weight. And actually, I would say that what is a little ironic whenever you look at what happened since the new CEO came in 2022 is that I think he's done a better job than what his KPIs are telling him that he should. And, in a way, it's kind of like nice that looks like he has so much integrity to do the right things for the shareholders, despite what I kind of feel are a bit inferior KPIs. In a way, you can also say it's pretty bad that the incentives are not fully aligned in the first place. All of that being said, there are some guardrails, though, where, for example, whenever I'm looking at a stock where it's not of the highest quality, it's decent, you're worried that you're going to catch a falling knife, I do like to be paid while I'm waiting, and there's a very decent 50% payout ratio on adjusted earnings. We can go into some of the adjusted numbers afterwards, but they're somewhat straightforward. And so that is roughly 5% yield that you will be getting right now while you're waiting. And so they bought back 400 million pounds here in 2023, and they did that really fast. And at the time, it was equivalent to 5.6% of the shares outstanding. Now it would be equivalent to 10% if they did it at today's prices. And I would love to see more share repurchases soon. And those decisions are usually made by the board and not by the management. So there are some guardrails in terms of like what they can do and how they're incentivized that comes from the board. That is everything else more aligned with you as a shareholder than if you just read the proxy statement. So there's a bit more to be said about Burberry, about the valuation and whatnot, but I wanted to throw it over to you, Jens, first before I proceed with that.
I've got a question for you, Stig. That Burberry is famously a rebrand, and it was famously associated with the early 2000s, sort of mid 2000s. That's like a dysphomistic term for folks in the UK. Now, I don't know how bad that word is to call somebody. I think it's a pretty mild insult, but they famously covered themselves in Burberry. It was like their sort of emblems. And there was this period where it got picked up on. All the newspapers knew about it. All the television shows knew about it. You know, they're Shameless and other things like this sort of dug into that subculture a little bit, where these people were wearing the famous Burberry kind of grey check, you know, which is what Burberry is known for. And that damaged the brand. And so they had to find this way to pivot away from this subculture and sort of make themselves back into this aspirational luxury brand, which they've done that over the last sort of 15 years to kind of get away from that, because it's not an issue now. But it is kind of interesting to me that there must be a lot of people around who are sort of my vintage who remember that pretty clearly. And people who are like our vintage are the ones who have the, you know, excess cash to spend on stuff like this. So what's going to lure people like us back to that brand? And is it sort of irretrievably damaged, or do you think they can turn it around, or they have turned it around?
Toby, I think that's such a great question. And I was discussing Burberry in our Mastermind community, and one of the members brought that point up exactly. You know, a brand means so many different things to different people. And originally I thought, and now I might have to think differently about it on my very small sample size, but I thought, you know, if you're a certain generation, and perhaps if you're based in the UK, and perhaps it wasn't just a UK thing, they have like 8% of their business in the UK. And I was about to come up with a cheeky comment about you call football and not soccer like half of our listeners do. Like, perhaps that's an issue. But then also you look at the main market, and that is in countries that are really into football. And they probably don't remember, and they don't know what a Millwall hooligan is, or you're just like, perhaps it's not a thing. And so I don't really know how to best respond to that. And they have they break down like the generations, not very detailed on age, but a generation like Gen Zs, millennials, and whatnot in your annual reports. And I was going through that after having spoke to our community member who talked about like what do people think whenever they think the famous check. And you know, I especially think that a brand like Burberry, and I would completely forgive you if you went into the website and it's like, this is pretty ugly. And I this is not my way of saying Burberry's cool. I do think that what's important about whenever you as a stock investor is not just to think about how you see the world, but look at the numbers and like, what does the world think? And if you would wear a brand like Burberry, like it's very like in your face. And there are some people and some cultures that would like to display that more than others. I'm really trying to be political correct as I'm saying all of this. And I think that's very important in terms of, I'm not saying one thing is right or one thing is wrong. Let me give you an example of that. I was visiting a Burberry store in Manila, Philippines some time ago, and I was looking for a belt. And there's a long story why, because it probably sounds super odd. What were you doing in Manila and why were you looking for a belt? Let's not go there this time. But I remember going in there and thinking that the store had a very different feel than, say, the flagship store in Bond Street in London. And the belts were very explicit and the brand was very explicit. Let me put it like that. And of course, it's a higher brand, so you're surrounded by salespeople who want to give you a wonderful service. And so I asked her do you have a belt where you can't see the brand? And she looked at me I was asking her whether I could walk on the moon. She's like,
why would you want that?
Why would you have something that's Burberry if people can't see it's Burberry? And that's because in the Danish culture, if you wear a big brand, it means that it's to some extent, it means either it's a knockoff or it's a very quiet luxury type of culture. So you're not supposed to wear brands. It's frowned upon to a large extent. And so I think there's something to be said about the perception of brand and understanding, who's the core customer? And are you the core customer if you're looking at some of the products and you're like, this is odd. Why do they have 3 billion pounds in top line? Well, that's because people don't agree with you on what looks nice. Apparently so.
The other question that I had, there's a huge debt. It took on a whole lot of debt a few years ago. What was the reason for that? Did they make an acquisition or were they buying back stock, or where's that come from?
Yeah, so I'm really happy you brought that up. So if you look at that, if you look at just at the total debt, it's important because they actually have very little debt. They have operating leases. So it's the way it works. And so if you look at IFRS, they're supposed to, it's counted as debt, but it's counted as rights of use assets in the assets column of your balance sheet. So they do have net cash is the first thing I'd say. If the thought of T accounts just make you fall asleep and you have no idea what you're talking about, that's perfectly fine. What I'll do is that I'm going to link to this specific example of IFRS. So in the US, you use GAAP. Burberry would be, so you could company, and basically the rest of the world, they're using IFRS. So I'm just going to link to an example of how that's being counted and why the debt they have on the balance sheet isn't quote unquote real debt. So I kind of feel I copped out on that one, Toby.
That's good. Otherwise, I think it's a really strong pick. It's got all the things that I really like. It's a very cheap valuation, and as you point out, it's got huge margins. So it's one of those things where, I can see this working out really well over a long period of time because it's been around for so long. It's a great brand. It's got good margins, so they are able to convert that brand into people will pay up for it. It's got good top line. It's so cheap. This is the sort of thing that I would buy. I don't know, but it is the sort of thing that I would buy.
Definitely the brand, and especially many of these countries that are growing their GDPs with a lot of middle class coming up. This can be a very good aspirational brand in those countries. And also, I think one interesting thing you brought up was it's not about volume here. It's about margins because it's a luxury brand. And I'm assuming the margin compares to other luxury brands. The only thing that I was curious was about lack of insider ownership, because many of these luxury brands are family owned and they're able to make long-term bets. And that might be the only risk here if the management is not able to make those long-term bets. But I think the price is so attractive that, you kind of bake into it already.
Yeah, so I'm really happy that you say that, Hari, because you are right. Many of the luxury brands are owned by families, and they do not focus on, ironically, they focus on shareholder value, but they don't really focus on shareholder value, which is one of those wonderful things about capitalism, that sometimes shareholder value can be an indirect effect of thinking long term. But I might be too bullish here as I'm saying this. Let's say that there is a bull case, and then there's a base case, and then a bear case. Then you might say that there's a put option to some extent on the bear case because it's not family owned and because it could be snapped up by a luxury conglomerate. Like LVMH would probably be the most obvious choice, not caring, considering everything they're going through right now. And I have thought about that, and I'm not saying that it's a big part of my thesis that you would have that put option, whatever you want to call it, that someone would come in and buy them up. Because I was discussing this with our mastermind community, and then someone said to me, well, Stig, if that is the case and it's so cheap, why hasn't it been acquired? And that's a great argument. What is that we're not seeing? But I think it's important to say that the lack of inside ownership can, in its own way, and I'm trying to be very positive, I'm saying this, but it might even be a catalyst potentially if they were to be acquired. So let me give you one example. LVMH really wanted to buy MS some years back, and I think they're quite up to 20%. And the families all, because there are many families, there's 6th generation now with MS, they all joined together and they said, we don't want to be acquired regardless of the price. That is not the strategy that Burberry has. And so actually with the previous, under the previous management, there were rumors, close to management and board, whatever that means. They came out and said, we really want to be acquired. And I was just thinking like that type of rumors that they probably started themselves. They wanted to get a tender offer, call it 20 or 30% above market price, would not be something you'll hear from a lot of brands. And I kind of feel that is an interesting element to this. But if we can go back and talk about, hey, if this is if not a great company, then at least a decent company, why is it so cheap? And like I mentioned, there's some hair on it. And so one of the things is that the industry is facing some short-term problems. And now I'm not an expert whenever it comes to what looks good in terms of clothing and whatnot. But so I don't think I'm the right person to say the creative output isn't the way it should be. I think I probably take the long-term view of saying this is a high-end brand that's been with us for more than 160 years. It's not really about the last few collections that's come out, whether or not it looks good or bad. I think it's up for you to decide, but it is an industry-wide issue right now. The luxury sector is in a slump. I previously pitched LVMH here on the show, and so I've been reading, their earnings reports and whatnot, and they're a good indicator of, because they're more, I wouldn't say they are the industry, but they have so many brands in the industry. You can also see Kering just coming out. They tanked 7%, like Gucci. I think it went down, I want to say revenue fell 21%. Like you see a lot of pain right now in the luxury industry. And so you might be saying that doesn't make any sense. Like MS sent out their last quarterly report and they were up 70% on revenue. And you're like, what's going on? So again, we have different tiers within the luxury segment where for a company like Burberry that it's at the lower end, they have a lot of what's referred to as aspirational luxury shoppers. So they're way more hit by the economy.
The chavs.
Right, exactly. And by inflation to extend that, call it old money, the quiet luxury type people who would buy the MSs of the world are just not.
Hey guys, it's Clay Fink here, host of We Study Billionaires. Today, I wanted to tell you about our show sponsor, Vacasa. The dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the US, they know how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a data-driven booking platform, and around-the-clock support, homeowners earn on average 20% more revenue from their vacation homes. Vacasa makes vacation home ownership easy. If you're looking to make more from your vacation homes by doing less, partner with Vacasa at vacasa.com. That's vacasa.com.
And so a part of the thesis, and I'm always ashamed of saying this because it is a bit about, do I dare say, timing the market? It sounds terrible. So I read this memo a long time ago from Howard Marks, and he talked about whenever you have market cycles, what kind of company that would be hit the hardest and which kind of company that would benefit the most. And he talked about how whenever industry is in a slump, how you should make sure to buy low quality companies. And it sounds so counterintuitive, but his take was that those are the companies that get punished the most. And if they have clean balance sheets, they're also going to rebound the most compared to the MSs of the world that's trading at 50 times earnings because people know they're doing well. And so I took that and then I squared it with, Peter Lynch's wonderful book, Beat the Street, and he talks about investing in cyclicals. And I kind of felt he had this wonderful quote where he talks about investing in cyclicals is like playing blackjack, because if you stay in too long, the house is eventually going to win. And so there is this thing, whenever you buy cyclicals, especially not the high-end luxury, but discretionary still. You want to, it is a bit of a game of what do other people think and when do they think that is so. And so whenever I'm looking at that, I think that there is a very interesting case here for Burberry. I am acknowledging now that they've been out with profit warnings. Some of the trading earnings are not going to look as nice whenever it comes out here. They already addressed that at length in the press releases. But I can't help but think, if we buy it at the current price, so the market cap right now is 4 billion. Keep in mind, if you look at the enterprise value, we have the IFRS 16 thing about operating leases. So let's just call it 4 billion right now. So would I buy the entire company at 4 billion? And right now the stock is trading at 1150 pence. So 1,150 pence. I would probably like a bigger margin of safety, especially because as much as we like to talk about asymmetric bets, I do think that there is case to be made that things can go worse, even for a brand like Burberry. But let's say that we have $4 billion in top line, which I think is absolutely achievable. Right now it's 3 billion. We have a PE of 20, and we have operating margins of 20%. And so if you do all the math, and knowing that the corporate tax rate in the UK is 25%, so we're probably looking, let's say that this is going to come to fruition, we're looking at a company that should have a market cap of 10 to 12 billion British pounds. Again, trading at 4 billion right now. Of course, this is the bull case. The base case for me is closer to 5.5 to 6 billion. And then we have the bear case where I want to argue that there might be a put option somewhere. So with all of that being said, that's my pick here for today, Burberry. Please continue your bashing, Jens.
I liked it.
Yeah, I don't find much to bash here, Stig. I think you gave both the cases, the bull and the bear already. It's an interesting pick. It's just a question of what's the upside? Because it looks like a lot of the bad news has been baked into the price. So I think, would I invest in this compared to, say, just investing in an index fund? Maybe yes, because indexes are now overvalued in US.
All right. Thank you so much for your feedback, Jens. Who wants to go next with his pick?
I think, Toby, you want to go?
I got a short and sweet one. So the stock is Playtika. The ticker is PLTK. They make mobile games. I can read off a list of these names, but Board Kings, House of Fun. If you guys play any of those on your phones, then you're playing a Playtika game. The stock IPO'd in 2021 at north of $30. It's currently trading at $7.24. They've torn up 80% of their valuation. I think they listed in the tech kind of mania, and a lot of the heat has come out of it, combined with the fact that they had some pretty good growth when they listed, pretty good historical growth when they listed, and the growth has slowed very materially there. They're growing about 1% year on year, which is probably less than inflation. So in real terms, they're probably shrinking, which is why the stock is down so much, I would say. I think they sort of blame it on, they say there have been these privacy updates, which have made, I'm guessing this is like an iPhone through the App Store mostly, but evidently that's made it much harder to market these games, and it's made it much harder to monetize these games for these guys. So that's been their big problem. They tend to have these like celebrity endorsements of their games. That's how they do it. They have some celebrity play the game. So each game is associated with a celebrity. I'm not going to mention them because I don't think you'll recognize the games. It's not a very big company. It's a $2.7 billion market capitalization now. It's got a little bit of debt, so EV's 4.2. For that, they're expecting for this year revenues of $2.6 billion. So it's about 1 times revenue, which is pretty good considering that because it's a tech company, because it's a gaming company, their gross margins are north of 70%, that's very fat. So they're making lots of money. EBIT, like 472 million. So EV EBIT is 745 for the year to come. So it's like 6 times on an EV EBITDA basis. Free cash flow, like $436 million. So 9.5 times free cash flow. PE is about 11. And it's still run by the founder, CEO, who established it in 2010. One of the things that they're doing in a sort of effort to resuscitate the stock price, resuscitate the business a little bit, is they're doing what all of the rest of Silicon Valley is doing. They're doing this efficiency push, which means layoffs. And so I think when you look at this company, it looks like stock's down 80%, growth has slowed to a standstill. They're doing layoffs and they're saying that there are problems with marketing and monetization of their games, which doesn't sound particularly good. And then on top of that, they're Israeli and they've got some employees in the Ukraine. So they're involved in both sort of geopolitical conflicts that are on the news at the moment. So all of that is very bad news for this business. But I like it for the reason that they definitely do have very substantial free cash flow in this business that they don't need to grow this business, and they don't need it in the business. So they've said that they're going to start paying a dividend. They've started at $150 million a year, which at the current market price is a dividend yield of 5.5%, which is a pretty fat dividend yield. They also said that they plan to do some acquisitions. And so the founder CEO, he wants to do these acquisitions. Evidently, there's some stuff out there that they can buy. They may be a target themselves. There are other bigger gaming companies, AppLovin and various other sort of names that you would recognize in this industry. So I think optically, it's something that looks like it's got a lot of problems. Under the hood, the balance sheet, financial statements, balance sheet's probably less than ideal because of the debt, but they seem to be able to set that debt pretty well. But I should mention that the Altman Z-score is trending, is towards distress here. So my system excludes things that fail on various statistical measures of earnings manipulation and fraud and financial distress. And that's one of the measures that I look at, but it wasn't triggered in my system because I try to look at the things that collectively have all of these problems. And this is a unique problem. And when I look at the rest of the financial statements, I think that it's okay. So it's generating, top line is still huge. Margins are huge. There's lots of cash flowing into this business. It's manifesting as free cash flow and dividends, and they'll be able to do acquisitions. So I think it's very healthy. I buy these companies for my funds. I own this company in the fund. It's one of the companies that I own in Zig, which is my mid-cap large. It's one of 30 positions in that company. I buy them all at equal weight. I rebalance them at equal weight. Come the next rebalance date, it's entirely possible that I sell out of it. I don't know where we're going to be at that point. It's entirely possible that I continue to hold it. I just don't know before I come to the rebalance date what's going to happen. So if you hear this after the fact and then you go and look at the portfolio and it's not in there, that's the reason why. I can see that stock price up 2 times from here, and I still don't think it would be a particularly expensive company. So that's my pitch. It has obvious problems, but I think that in the context that I buy these things as part of a portfolio, it's a nice risk adjust. And so I've put it on. Gents.
This is a very interesting pick, Toby, especially gaming. I have a teenager at home, so I'm looking at all the different gaming companies too. Myself, I think it's a very interesting company because, as you said, the margins are really high. It's a profitable model. Distribution is also not that difficult for them because they're on the platforms. However, I think that couple of concerns is, one, if I look at it as a long-term holding, I don't think you are looking at it that way. It's kind of probably medium-term for you. So if I look at it at a long-term holding, then I have few concerns in the sense that, number one, why are they declaring dividends so fast? They're just out of the IPO a few years back. Number two is their organic growth has been not that great. It's always through acquisition in terms of their revenue. And now that they can't acquire more, their revenue is kind of declining or stagnant. And then their daily active user is also declining by 6 or 7% year over year. This tells me that the moat is like narrow or low. It's like its switching cost is not there. Gamers can be flickery. And then they also have this casino stream of business or games that can have regulation risk at some point or the other in some geography or the other. So those are all some of the risks to the stock. Having said that, I think, of course, the geopolitical risk. But what I've found in my experience is engineers in Israel are the most resilient ones. There might be like missile sirens going off, but they'll be still working. So I wouldn't worry about the geopolitical risk that much. Why are they not able to grow revenues organically? And whether they're able to hold the attention of the gamers who are very easy to kind of, lose.
Fickle.
Yeah. Yeah, I didn't want to use that word, but yes, that's accurate.
Yeah, I think that's exactly the problem with this thing that nobody games. I think maybe that's not right. Maybe it's adults as well, but people play these games, they run out of interest pretty quickly and then they just move on to a next one. It's a little bit hit or miss. Having said that, they've sort of got this machine for developing these games or buying these games, monetizing these games. That's sort of what you're buying rather than any particular. That's why I didn't spend too much games, because it's going to be irrelevant. They have a way of marketing, getting attention, getting people to play the games, that those wells run dry very quickly. So then they have to move on to the next thing. I agree with all of that. And that's a problem for these guys, that they will have to find something that works. But, you know, I kind of feel that's what they do. They'll be able to find something. I don't think it's going to be a blockbuster. I don't think that this is a sort of stock. I don't think this is as good as Burberry, where I don't think in 150 years' time, Playtika will still be there. Maybe I'll be wrong, but there's a good chance Burberry will still be there. So I agree with you in the longevity of this thing. There's a limit to it. But it's very cheap. It's throwing off a lot of cash. Founder CEO is still there. So I like operator-owner type CEOs. I think that they often know the industry pretty well and they know their way around. So I like this as a bet, but I agree. As I said before, I can roll out of these things pretty quickly. So it's not I always plan to hold them for a long term, but you know, if there are better opportunities or it goes in the wrong direction, I'll be out.
I just want to say here from the latest earnings call, the celebrities here: Sarah Jessica Parker for Solitude Grand Harvest, Jason Alexander for World Series of Poker, and they continue the partnership with Drew Barrymore for Bingo Blitz. So whenever I was looking for the celebrities for like a Burberry's website, I didn't know any of them, which to me meant they were probably cool. I know all the celebrities here for this company. And if you haven't watched TV in the 90s, you might not know them. And I kind of like that.
There was one more guy that I didn't even recognize him, the fourth guy, Ty Pennington.
Yeah, who's that?
Couldn't tell you. Didn't even look it up.
He's a celebrity for someone.
You know, I was reading this study here the other day. I think it was from Bain. And I'm always a bit worried about, you know, if it's created by consultants. I don't know if I'm going to insult any consultants by saying this, but if the advice you get from the consultants are you need more consulting, I just always get a bit worried. And so Bain made this conclusion that the more companies you acquire, the better it is, which obviously for a company that relies on M&A fees, it makes sense to make that conclusion. But if you do think about it, there are some companies that do a very good job acquiring companies and make it their skill to acquire companies. Of course, it requires...
Like Constellation or Berkshire or something like that.
Constellation or Berkshire, yes. Most serial acquirers are cut from a very different cloth and they can't pull it off. Like, it's very difficult to grow through M&As. And so it very much depends on how well is the M&A gene like a part of the company DNA. And what a lot of companies do after they've matured is that all of a sudden they say, we can't really grow organically, so let's start to acquire stuff and grow that way. And that is usually always a bad decision. So it's very important whenever you look at a company like this to ask yourself, is this how they've grown so far? Are they good at it? Or is it a new shift in strategy? Then whenever you read about their capital allocation, and I'll be the first one to say that it's not because I like being taxed on dividends by any means, but I do think that there's something to be said about a certain type of quality company. And here I refer to not of the highest quality company. It's probably okay to get a dividend. And especially if you're a bit worried about whether or not it's a value trap, while you're waiting for that multiple expansion, which is part of the thesis here, it's okay to be paid. And so I completely understand where you're coming from, Harry, whenever you're talking about, wow, that dividend came in fast. Whenever I'm looking at the financials, I'm looking at, sales and marketing went up 24% year over year. And it's not because it's crazy that it's the case, because, they do have 70% gross margins and they have very, very decent, like it used to be low 20s, now it's like high teens in terms of operating margin. Like it's very common for those type of companies that they do spend a lot of sales and marketing, but also in the industry where, you need distribution to your point before, you need to bring people in, it is the cost of doing business. And so for a company like this, that might have been short to some extent, that's trading at a low multiple. Like they talked about it on the earnings call that they would look into share repurchases. I do think that is probably not the right strategy for a company like this. Whenever you're looking at share repurchase, you would say, what is the intrinsic value and do I buy below the intrinsic value? And I think that is how you should be looking at it. Another framework I want to share is asking, is the business getting better? Which again, of course, goes into what's the intrinsic value. That's a part of that calculation. But a lot of companies have tried to boost their share price by buying back stocks. And simplistically, you don't want a company to spend their cash on buying back 50% of shares outstanding if you as a shareholder then own, you have twice the ownership of a company that's worth half of what it used to be. You would probably rather get paid that in dividend instead. So that would be my feedback here for your pick, Toby.
Great feedback. Thanks, Stig. I'll take all of that on board. And so that's my pitch. Should we do Harry's?
Thank you. And my pick is not at all in the value corner this time. So Toby and Stig, please forgive me. But I wanted to bring this up because I've been chatting with a lot of folks, especially my investor friends in India and my own experience looking at the market. And I'm hearing a lot about, hey, how do you get into the India investing game, or how do you get a slice of the growth in India? And one of the ways I was thinking is, how about if you look into the banks in India? Because one of the things I see with India is it has a really positive demographics, and that's going to stay for the next 30 years. The GDP is growing 7 to 8%, even with all the headwinds that we are seeing. In fact, like if the condition gets better, it will cross 10%. So India is like where China was in the 1980s. There is a lot of appetite and a lot of actual need to build infrastructure. So that both public and private. And the government is also making policies that are conducive for business. In a way, I see India is turning capitalist with huge enthusiasm. But when all this happens, you need a lot of credit for the economy to grow. So it's at 4 trillion today. It will be 10 trillion in a few years. So when it is growing at 7 to 10%, 6 to 7 years or 8 years, it might be 10 trillion. How do you capture some piece of it? And one of the ways I was thinking was through banks. And the reason there is another bunch of catalysts for banks in India. So one, I already talked about the sustained credit growth and the need for credit growth. It has been growing at 10% over the past decade, and I believe it will only accelerate. The second more important thing is the adoption of digital technologies. It has made lending more efficient and distribution also more efficient, whether it is banking or lending, credit approval and everything. In fact, the last few years, the digital lending market has witnessed a compounded growth of 40% almost. It is projected to surpass $720 billion by 2030 and a total 1.3 trillion digital lending market opportunity. On top of that, the government is also very supportive in terms of its policy. One, I think, is a very famous policy by Prime Minister Modi, which is called as the Jan Dhan, wherein he brought hundreds of millions of people to the fold of banking. For the first time, they were getting banking accounts. In fact, the rate at which number of people having bank accounts have grown in the past 10 years is astounding. Like in 2013, there were 450 or 460 million people or accounts, at least bank accounts in India. Today in 2023, by 2023, it might be more today. By March 2023, it was around 3 billion accounts. So a lot of, especially all classes of people have been brought into banking, and now they're going digital on top of that because of demonetization and the India stack, as they call it, which is the fintech stack. In India now, when I go, in my personal experience, even the beggars we call it beggars or the homeless, they have a QR code. So a street vendor has a QR code. Nobody uses cash. So a lot of digitization has happened. So a lot of money is flowing into the banking system as well. And on top of that, there is a recognition by the government that India used to especially when India was socialist 30 years back, they used to despise big banks because they feel like they will have more power. So they started breaking down and nationalizing a lot of banks 40 years back. Now it's the reverse. And the government has been pushing for privatization and also consolidation because they feel having a lot of small banks is not helping build the infrastructure they need to build, because the kind of credit that needs to be made available for bigger banks is important. So there's a lot of consolidation happening in the banking sector, and the banks are going to go bigger, and that's the intention of the policy. They're also supporting them by introducing policies like bankruptcy code. Imagine till 2016, there was no bankruptcy code in India. So if you go bankrupt, there was no clean resolution. And because of that, it was very hard to hold the businesses accountable. There are a lot of businesses who would kind of, take money but never give back. There are a lot of kickbacks happening. There was less transparency and there was less risk for the banks because a lot of it was driven by the government or corruption and stuff like that. So all that has been cleaned out, and that is visible in all the NPAs, non-performing assets or credits, across all the banks, not just ICICI that I'll be pitching today, but everybody has cleaned up in the last 5 to 6 years. And they're now in a state where now they can again focus on aggressive credit expansion. And that's why the asset quality is improving. And then they have very good capital adequacy ratios right now. So the entire banking sector is at around 16% now, which has a very good cushion. And as we are talking about consolidation, now there are the top 5 banks now today hold 50% of the entire deposits of the country. And ICICI is one of them. It's the number 5. And HDFC that I had brought up like some time back is number 2. So ICICI has around $128 billion in deposits. For comparison, HDFC has $189 billion in deposits. The top bank, which is a state-owned bank, it's called State Bank of India, it has the highest. It has around $491 billion, just as a comparison, and 23% of the entire bank deposits. HDFC has around 9% and ICICI has around 6%. However, the reason I'm pitching ICICI, and I would be comfortable holding both HDFC and ICICI because those are the only 2 ADRs available. If there is anybody from India listening in, I would suggest you can expand your basket to another bank called Kotak Mahindra. There is Axis Bank. And then there is a NBFC called Bajaj Finance, which I'm a big fan of, which is much higher growth and profitability than all these. So if you make it a basket, then you're really capturing the entire Indian growth. But today I'm going to be talking about ICICI, which is the 5th largest bank, as I said, $128 billion in deposits, growing at 10% CAGR for the last 5 years. They had a scandal in 2014, 13, 14, 15, which when a lot of banks had scandals, they were one of them. And because of that, they had quite a time restructuring everything till 2018. After that, they have recovered and they have been growing steadily. Their bank deposits, their loan growth is at 14% CAGR, and the revenue is around $27 billion, net income of $2.25 billion, which is growing at 17% over the past 5 years CAGR, and a net interest margin of 4.3%. They're definitely not cheap because their price to book is 3.7 and their PE ratio is 18.5. But when you look at the growth rates in terms of revenues or the interest income, and also when you look at the overall India story and how India as a GDP is growing, how the banking inclusion is growing. And with that, they're also getting this opportunity to cross-sell. Like for a very long time, when I was growing up in India, all we did at bank was just go deposit money and get the money back. But now when I go to any of these banks, I go to ICICI, HDFC, whenever I go, I have my accounts there. They pitch me different products, whether it's insurance products, whether it is portfolio management products, whether it is mutual funds, whether it is fixed deposits, money market funds, and private banking facilities. They have a bunch of different products, very similar to US banks. So if I think of these banks, they're all like what Wells Fargo or JP Morgan Chase or Bank of America were in the 1950s, probably. They're at that nascent stage. So my pitch here is you got to hold on to this for the next 15 to 20 years. And the RBI, which is the Fed of India, Reserve Bank of India, has three banks, or two banks, I believe, HDFC and ICICI, has been recognized as the systematically critical banks. So that means they are covered by the equivalent of FDIC insurance. So to Toby's point, for the next 30 years, Toby, I'm pretty sure these banks will stay. As long as the India growth story is alive, these guys will do well. So that's my pitch. I would submit to you in terms of valuation. What do you think? I know that, it's right now hot, the Indian market, but among them, I felt ICICI and HDFC are kind of relatively reasonably priced for the growth that they'll capture in Indian market.
I like the pitch, Harry. I wrote a book called Concentrated Investing. I have it just here. Came out in 2016. I was just trying to remember that we had an interview with an investor who had looked at all of the Indian banks quite a long time ago. And I don't think that investor actually made it into the book. So I can't remember if I've told this story in the book or not, but they looked at the Indian banks as a way to get into, for exactly the same reason that you have identified them, that India was going to do very well. They wanted to be exposed to India. That was the smartest, easiest, most direct, highest torque, highest return on investment way of doing that was to be invested in the banks. And they had done it much earlier. And so we wrote Concentrated Investing in 2016. And I had a look in 2016. And his thesis was you want to be invested in the biggest bank rather than or the second biggest or the third biggest, rather than a long way down the list, because that was the surest, safest way of doing it. And I looked in 2016 and I looked at ICICI just then, and I noted that when I looked at it in 2016, the stock price hadn't gone anywhere since 2005, and it had gone up and down quite a few times in that period of time. It just hadn't moved at all over that period, and it was trading around $5 in 2016, or maybe even a little bit less than that, $5 in 2006 or 2005. And I had a look at it then. I think it's trading closer to $30 now. So it did finally get that giant run. It looks like it's run really hard and it's looking a little bit stretched. But you point out that there's massive growth coming in India for infrastructure, and it's going to require all of this credit. So it's likely that these banks continue to get better. But my questions are, and I think I do vaguely remember us doing an Indian bank discussion on a Mastermind some years back. So I think my question is the same now as it is then. Why not? Is this one of the biggest banks, and therefore it falls into that category of you're going to be fairly, you don't need to go finding the value bank here. You just need to find banks that will be beneficiaries of this theme that you're identifying. And is this bank therefore in that bucket of banks, and it's safe to buy this bank for that reason? And the other question is, do you feel like this valuation is stretched, and the problem might be, even though you do get all of that underlying growth, is the issue that it takes a little while to catch up to the valuation, and you have something similar to what happened between 2005 and 2015 or 6 and 16, where the stock price didn't really go anywhere. Just interested in your thoughts on those two.
Yeah, no, thank you, Toby. I think those are really good questions. So I'll answer the first one, that is it one of the biggest bank? I think it is one of the biggest banks in terms of the private banks. So in the top 5, there is 3 state-owned banks and 2 private banks, that is HDFC and ICICI. And ICICI is one of the top 5. The reason they were not doing well between 2005 and 2016 is because they had a lot of scandals then. And during that regime in general in India, there was a lot of corruption and scandals. And that's the reason that government was booted out. And ICICI was no exception to that, except HDFC, which stayed clean throughout the time. And that's the reason they're always richly valued. And what I've seen with HDFC, I think that might be the one that we had a discussion long time back. Anytime I saw HDFC, it felt expensive, but they always grew. And ICICI, I'm assuming, will be, now that it is clean and there is a new operator, CEO, Sandeep Bakshi, who is really well regarded in the industry. Finally, I'm assuming that ICICI will get into the class of HDFC, because 2005, 6, if you look at their deposits, they were both same. In fact, HDFC was slightly lower than ICICI. But then because of all this scandal, ICICI kind of lost its way, but now they're coming back. So that's number one. Number two, I agree that, holding the largest banks will be the best. But what I'm seeing is the value migration from state bank to the private banks because of the services they offer, and not just the volume, but the quality of our deposits. The kind of customers who tend to be with private banks are the ones who are the high value customers. And the state bank usually attracts the low kind of, LTV kind of customers. Because of the facilities the private banks give, it's on par with any other US bank in terms of their online digital banking facilities and also customer service. If you cross a certain amount of deposits in the bank, you get a private bank who will be available to you, can help you. Many times when I go to India, I don't even go to the bank. They come home and help me with all my stuff. And then you also brought up the other part is
just the valuation.
The valuation. Well, I think when I look at their valuation in terms of price to book, which is a good measure for any bank, 3 and 4. Yeah. But when I look at, say, something like JP Morgan Chase, it's 1.87, almost 2. So relatively they are valued higher, but then the way I'm looking at it is JP Morgan is so big, growth opportunity. And compared to JP Morgan, and if you look at the market cap of 93 billion and the deposits that are there, and it's going to grow in terms of the rate of growth of the GDP, I'm assuming, that the valuation will catch up eventually, but it's provided we are willing to hold it for a longer term. But yes, as at present, they're stretched, and any stock in India today will feel like that.
Yeah, I was looking at the CAPE ratios for globally, and perhaps no surprise to you, Hari, India is the most expensive, just overtaking the US now. And it's kind of interesting whenever you look at how the sector has been, different sectors been broken down. So in the States, financials are 25% and it's almost 38% in India. I know there's a lot that of course goes into that weighting. I was a bit surprised to see that, also considering how much is still public. I don't know, perhaps some of that is floating in the public markets, and so perhaps that explains some of it. To me, it's tricky. I can't, I completely buy into the thesis of the rise of India. I think most people do. Whether or not banks are the right way to play that, I don't know. I went through the earnings call here and tried to read the balance sheet, and I just don't understand it. And I don't know, it probably says more about my limited skill set than it says about the complications of it. They break down, it's wonderful. They have slides and they give their own ratings to the different assets, and that, who am I to say that whether it's AA minus or not, I don't really know. I think to me, it's a tricky bet. And you said 3.27 hard before on price to book. It seems high, but again, there might be some wonderful quality there that I don't really understand. What's interesting from a currency perspective is how much it has recently stabilized. Rupees, say, compared to the US dollar, for example, which has definitely been an issue in the past. And it seems like there is, for better or for worse, a more stable environment right now in India than in a long time. So I don't know the best way to play the bull case for India. I'm almost inclined to say something along the lines of buying a passive ETF, but then I also just said that it's priced very expensively, but at the same time, it's also the fastest growing of the big economies in the world, and why wouldn't it be priced as the most expensive? So those would be my 2 cents on your pick, Hari. Very interesting. Thank you for bringing it to the group.
Yeah, thank you, Stig. I think you brought up an interesting part. Why is India's 38% of India's stock market is financials? One of the reasons is they don't have big tech like US. In fact, I think the way I look at it is India is getting industrialized now, seriously, compared to the past at a very high rate. So I think there are a lot of different industries coming up now. But I think that's a good point, actually. Yes, the financials are quite a big component of the overall market. In the 90s and early 2000s, it was only outsourcing companies like Infosys and TCS who would just take projects and do for US companies. But lately, in the last 10 years, I'm seeing product companies, whether it is Freshworks or Zoho, or Zomato, there are many that went public recently in India, and there are many in the pipeline who are all product companies, mostly SaaS-based companies. Right now, it's more like you take the model in US, copy for Indian context, or you become the low-cost producer of the same product. That's the model that they are taking now. So it will be really interesting what next 20 years will bring. Or will there be innovation for India market will be yet to be seen.
All right. Fantastic, Hari and Toby. As always, thank you so much for your time. Before I let you go, could you kindly give a handoff, Hari, perhaps you first, to where people can learn more about you?
Yeah, I mostly hang out on Twitter, X now. Hari Rama is my handle. Would love to engage with you there and look forward to your comments and feedback. My blog is bitsbusiness.com.
I run Acquirers funds. We have two funds, Deep, which is small and micro domestic US value, and Zig, which is mid and large cap domestic US value. I've written some books that are all in Amazon under my name, and I have a website, acquirersmultiple.com, which has got some free screens and all of our blog posts and podcasts and various other things there. Thanks for having me, Stig.
Imagine how successful Spotify has been. They do not own the device like Google and Apple, and they also do not own the App Store. They're paying a tax to the biggest competitors. And yet, here we are, the most successful of all the apps. And so I think there was something to be said about having an audio-first, founder and controlled organization.